I'm David Bank, and from Impact Alpha, this is an Agents of Impact podcast.
Industry-wide, if we look at it holistically, it's about mispriced and undervalued products that more traditional venture capital private equity firms still understand that market opportunity like we do.
That's Bahiyah Yasmeen Robinson, founder and CEO of VC Include and Include Ventures. Include works to accelerate investment into women, Black, Latinx, Indigenous, LGBTQ, and other underrepresented fund managers in order to drive economic growth through the power of diversity. I sat down with Bahiyah at the recent Include conference in Berkeley, and I got the chance to meet as well with several of the emerging managers in Include Ventures' latest cohort. In coming weeks, we'll share some of those conversations. First, let's hear from Bahiyah. I'm here at Include with Bahiyah Yasmeen Robinson, the founder and CEO. Hi, Bahiyah.
Hi.
It's a pleasure to be with you.
Thanks for having me, David.
What are the highlights of today so far?
I think the highlights for me is one, how the corporates really came to both attend Include conference and to really learn both from, about the new fellows. Many of them have invested in cohort one. And if you recall, our first fellowship, that cohort in the last year has raised $250 million. And happy to report that some of that capital was through corporate investment by Amazon and PayPal and others. And so excited to see that, that interest, that continued interest. I know there's a lot of questions around will corporates continue to kind of make good on their promises to invest in underrepresented fund managers and founders. And we are seeing that that these corporates are looking for sustainable long-term solutions to their investment strategy post their initial marketing announcement of investment.
Now, we've heard the statistics about the small amounts of percentage of capital managed by managers of color, and it's always a tiny percentage, like 1.4%.
Sure.
Is that number budging at all, or are all the efforts of the last couple of years making a difference?
I think so. There's a couple of things to put into context, and it's always interesting to see media cover some of this because venture, as you know, is a very long-term investment as much as it's an alpha generating investment in the alternative space. I tend not to think about movement in terms of 12, 6 or 9 or 12 months. I look at it as a 3 to 5 year, has the needle moved kind of in, 5 years versus, 1 to 2. And so as much as the pandemic and George Floyd has really pushed the commitment amounts, the capital going out the door, it's still not fully executed. It's still it's not fully deployed yet. So that's one thing to consider is that amount seems like it's slowing because it's not fully deployed in many commitments. But I do think that we have an opportunity to stay um, focused on stakeholder engagement and making sure that those commitments continue to be deployed, or that the full commitment continues to be deployed. So I think that's one thing. 1.4% to move that needle takes a lot. And so I think we'll be able to measure this in the next 3 to 5 years on if that needle really has moved from that 1.4%. I mean, our mandate and our vision is to move that needle 10x in the next 10 years. And so it's important for us to look particularly at the venture capital and private equity space and be very thoughtful about building the pipeline and building the market and also making sure that we're connecting the right LPs that have an interest in both mission alignment as well as sustainability, climate and environment into this next generation of managers. And I think if we do that right, that number will move in the next 3 to 5 years.
Yeah, you've had, I think, 12 new fund managers in this year's cohort, and about equal number, I think, last year.
Yes, in the fellowship, we had 10 that graduated in 2021 that generated that $250 million in AUM. And then this is now 12 managers. The difference between the first cohort and this cohort is that all of the cohort of this year, 2022, have raised some capital. And so we thought it was important to find, because we had such a big number of applicants, find managers that had raised some capital and had some skin in the game around that momentum to be able to close their funds in the next 12 months.
But your vision, as you said this morning, was hundreds or thousands. So
Yeah.
how do you go from dozens to hundreds?
So accretive, right? Year on year. So we had 10 plus the 12 this year, plus the 10 climate funds. That's 32.
Okay.
So how do we get to 10 by, or excuse me, by to 100 by 2030? By being very intentional and making sure that our programs are graduating top notch, alpha generating, the best of the best firms in the market, and supporting them in all the ways we can in order to get over that line, to provide the resources and non-financial support that managers need, to make sure that they build resilient institutional grade asset management firms so that they're growing from a fund one to a fund two and a fund three. It's not just enough to raise your first fund. It has to be, value creating, alpha generating, and you're supposed to be able to raise your second fund and your third, right? So there's a few things that are important in order to get to numbers of later stage venture capital funds run and led by women and people of color.
There's a couple threads I want to pick up, but you just mentioned alpha generating, and that's come up a lot. The thesis is that there is alpha to be had here. Just what are the elements that generate alpha out of this thesis?
So the thesis around include is, sustainability, investing in diverse women, diverse founders, and diverse funds outperform the market just from a statistical, just from a data perspective. And we have lots of different, financial service investment firms, et cetera, that have shared reports on women-led firms outperforming the market, diverse-led teams outperforming the market. So we have that baseline data. I think what's important now is to build a resiliency around collecting data around impact metrics, around climate, decarbonization, and other kind of real ESG metrics that we can track year on year. So that's one piece, is the data piece, to see where certain industries are maybe generating more returns than others.
But the elements of that alpha are finding markets that are under tapped, or talent that is underappreciated, or kind of a different lens on opportunities.
Absolutely. So in terms of, I'd say the uh, I'd say if there's three pillars or three buckets, one is diverse teams, right? Second is um, investors that have a track record either as operators in a particular industry or as investment professionals that might not be spinning out with attribution from their old firms, but spinning out with an expertise in a particular investment thesis or strategy.
So they're considered first-time managers technically, but they have all kinds of other experience.
Absolutely, right? And so we're de-risking by understanding their track record and history of investing or building the type of firms that they want to invest in, right? Build successfully building and exiting out of the firms. And there's many examples of that, both in this cohort and the last cohort of folks that have done really well in their respective industries, and now they want to double down on that strategy to be wealth generators and also value creators and alpha generators.
There's a little bit of an irony, and people have educated me about it, that some of the alpha comes from the fact that these managers and these founders are undervalued and underappreciated, such that the
Or
valuations are
lower.
low, and
Yes.
therefore the upside is higher.
Yeah, I mean that's another distinct element, and it's about. I mean, we can talk about it. I talk about it as as underpriced or mispriced, product in the market, whether it's the company or whether it's which is undervalued and at a lower valuation, or what as an investor I call a discount, right? But I think industry wide, if we look at it holistically, it's about mispriced and undervalued products that more traditional venture capital private equity firms just don't understand that market opportunity like we do.
Tell us just a little bit about how you came to this work, and why you decided to start Include.
Sure. So I've been an impact investor and a social entrepreneur before impact investing was a good word. And I realized, as someone that's been in this space, both on the trying to figure out how to do well and do good at scale, that impact investing was going to be institutionalized or continue to grow in the institutional space. And I made a bet. I made a bet on, I saw that, both fund managers and founders were not being invested in, and that was a missed opportunity and a massive market opportunity. And I decided to build a platform before COVID and before people really caught on to this diverse emerging manager segment, to build a platform to just focus on this niche of women-led, diverse-led firms in the venture capital and private equity space, to make sure that as we kind of continue to build our asset management firm, that we were able to de-risk a lot of our investments by supporting some of these managers, learning more about their journeys, seeing how they do in a fund one versus a fund two, fund three, and also being an amplifier across the market for these market opportunities, whether we invest in them through Include Ventures or not. And so thinking about being a market maker and an influencer in the space that actually drives the impact, the climate justice, the things that we actually want to see in this space. It was just an opportunity to be a leader in the space, unbeknownst to me, that before the pandemic presented this accelerant of all this work.
Now, in addition to the accelerant, there's also the backlash, and it's come on strong. Maybe it got stemmed a little bit by the election results, in some way, maybe, but in any event, the opponents of ESG are on the march. How do you respond to them?
I ignore them. I ignore them. And the reason why I do is, again, because, I've been in this space for 15 or so years, and I'm a researcher. I look at, network effects. I also look at insights and trends because I've been investing across Africa, but, Europe as well as the US. There's a growing both need and mandate across really globally to solve some really large issues that have not been solved, and there's market based solutions that are technology driven that I'm seeing, right? And so, because I've been in the space for so long, I've seen some of the pretty unique opportunity sets that are ripe for both disruption and also ripe to scale. And so, for me, the folks that are crying about, ESG is not a thing, is going to see, they're going to see that environmental and social governance is actually going to be embedded in investment decisions going forward. I think for several reasons. One, the next generation, the millennials and below, are seeing that their world and their children and their grandchildren's world is going to be much hotter and much different and much more and not as safe as it's been for previous generations. And they're making other decisions and demanding for more impact investment solutions, whether it's within wealth management firms. They come to us and ask us and tell us that their clients are demanding more and more, increasingly year on year, demanding more climate focused investments, and also demanding more general impact and ESG opportunities. So they're actually, a lot of the allocators and asset owners are coming to us saying, you're building this resilient platform. We need our wealth managers, we need the large financial institutions to be in this room with you to learn, and to meet all of these managers, because this is what we want to invest in going forward. So the market and the data and the kind of the breadcrumbs point to more integrated ESG.
You mentioned that you want firms to be able to go from the first fund to the second fund to the third fund. There's some data that shows that the better managers perform, the tougher it is for them to get allocations from the asset allocators. The bias studies that Lumen Capital and Stanford did a couple of years back,
Sure.
Seemed to show that the bias actually increased with success.
Sure. Well, that's why the platform play is so important, because we're not just educating and supporting managers, we're actually educating and supporting asset owners and asset allocators as well. And so this holistic um, platform and approach allows allocators to get comfortable with building long-term relationships and seeing how this is actually going to benefit their bottom line and actually increase the alpha created in their portfolio companies, and therefore won't be as resistant to investing in later stage diverse led firms.
And was the takeaway from that study was that maybe the first fund, I mean, this education I think is critical. Takeaway was that that first fund was sort of could be a gesture of some sort,
Right.
but the second fund, which presumably is larger, then it becomes like a serious investment, and they were less willing to do that. Is that what the lesson of that? I mean, it was a kind of a counterintuitive finding, as I remember.
Well, this starts to, press against the concept of implicit bias. When you have a number of, funds, the later stage funds, there's actually it's more competitive in the sense of there's less diverse funds and more non-diverse funds. And so if you already have a portfolio of fund threes or fund fours or even some fund twos, you actually have to think a lot about your portfolio construction. So if you don't have high conviction for those managers themselves in that team, then it becomes less attractive to continue to invest in them. That's a general context. So where bias plays in is if you have a manager that you've known from B school that spent a bunch of time at Blackstone or BlackRock or one of the larger investment management firms, and maybe easily raise their first time fund, and you're putting a little capital into a underrepresented manager, but they do really well. Now you've got your the person that you kind of known for a long time, and then this new manager, still new because it's a second time fund or even a third time fund, it's technically still emerging, right? And they're up against these other more kind of institutional leaning managers that are tracking more to their peer group. And so then it becomes, do I invest in the peer group, or do I invest in this and go out on a quote unquote a limb and still invest in an emerging manager that might not be part of my peer group, that I might not know quite as well? And so I think all of those things are part of that bias. Some of it is just, racism. It's either the white guy, it's a black guy, I'm going to choose the white guy. But I think because the asset management field is so relationship based, it's usually based on relationships that they're choosing these managers.
And so you're saying that the education now is at the allocator level. I mean, at some level, as the data comes in, as you say, they're breaching their fiduciary duty
Exactly.
by not looking at this and by not examining their own implicit bias.
Absolutely. And so they're losing out on alpha because of their implicit bias. And so that's where we're trying to, what I call change hearts and minds around where the opportunity set is, and that everyone will benefit by investing in high performing, outperforming, diverse and women led managers.
Easier to change hearts and minds when you can deliver alpha.
Right.
Thank you, Bahiyah. It's a pleasure.
Yeah, thank you.
That's going to do it for this Agents of Impact podcast. You can read more about Bahiyah, Include, and emerging fund managers at impactalpha.com. Big thanks to Bahiyah, to our producer Isaac Silk, and to the whole team at Impact Alpha, investment news for a sustainable edge. And to all of you, Agents of Impact, thanks again for all that you do.